The path to meaningful profits. The same market move can mean $10 or $10,000. It depends on how you trade. In this lesson, you'll learn how traders scale gains and what each means for your risk and reward. Your potential profit is directly tied to your trading capital. With $100 in your account and a winning trade that nets 10%, you've made just $10. To earn $1,000 at that rate, you'd need to make 100 perfect trades. There must be a better way. Retail traders have developed methods to bridge this gap, such as leveraging capital, partnering with prop trading firms for increased buying power, and compounding smaller profits over time. Each of these has its own characteristics and suits different trading styles. Let's start with leverage. It lets you trade with more money than you actually have. If you use 10-to-1 leverage, it means every $1 you have controls $10 in the market. So if you have $1,000, you can trade as if you had $10,000. That way, even a small price move, like 5%, earns $500 instead of $50. Time for a quick quiz. A trader has $2,000 and uses 10-to-1 leverage. That gives them control of $20,000. The market moves up by 3%. How much profit do they make? Is it $2,000, $600, $200, or $60? Yes, you're right. That's right. 3% of $20,000 is $600. With 10-to-1 leverage, even small moves can lead to bigger results, and bigger risks too. When you trade with leverage, both gains and losses are multiplied. For example, a 10% market move with 5-to-1 leverage results in a 50% change to your account, whether it's a gain or a loss. Leverage is provided by your broker in exchange for a margin deposit. This margin acts as collateral to make sure you can cover any potential losses. Different markets offer different leverage ratios. For example, the foreign exchange market might offer 50-to-1 leverage, while stocks might limit you to 2-to-1. If your position moves against you too much, increasing your loss, you may face a margin call from your broker requiring additional funds. Without proper risk management, leverage can quickly deplete your trading account. The second approach is joining a proprietary prop trading firm. These companies provide traders with much larger capital in exchange for a share of the profits. Instead of trading $1,000, you might trade $100,000 or more. Prop firms typically require you to pass a trading evaluation first, demonstrating your strategy works and you can manage risk appropriately. They'll have specific rules about maximum drawdowns and profit targets. Time for a quick quiz. Coin wants to significantly increase his trading profits. He's considering either using 10-1 leverage on his $1,000 account or applying to a prop firm that would let him trade with $50,000 after passing an evaluation. What's the main difference between using leverage and trading for a prop firm? Prop firms don't allow day trading, only long-term investing. Yes, you're right. Exactly. With leverage, you're amplifying both gains and losses on your own capital. With a prop firm, after passing their evaluation, you're trading their capital with less personal financial risk, though you'll share the profits when successful. The third approach is the most accessible but requires patience, compounding smaller gains over time. Instead of seeking huge immediate returns, focus on consistent smaller wins that build your account steadily. Remember the power of compounding we discussed in earlier lessons? A 5% monthly return might seem small, but that's almost 80% annually when compounded. Starting with $1,000 and achieving this rate, you'd have about $1,800 after a year. This is why many successful traders focus on consistency rather than hitting home runs. By preserving capital during drawdowns and steadily growing their account, they eventually reach a point where even average percentage returns can generate significant absolute profits. Quick task: order these trading approaches from lowest to highest personal financial risk. Knowledge check. Selecting your approach. Match each scaling approach with its primary requirement. You now understand how traders scale profits, manage risk, and grow their accounts using tools like leverage, prop firm capital, and compounding. Great job getting this far. Now let's practice what you've learned through different scenarios. Welcome to the practice round. You've learned the three main ways to grow a trading account: leverage, prop firm funding, and compounding. Now it's time to apply that knowledge. Quick knowledge check. Coin has $500 in savings. He's brand new to trading and wants to start slow without risking too much. What's the best option for Coin right now? Use 10-to-1 leverage to grow fast? Join a prop firm immediately? Or start compounding with small, consistent... Yes, you're right. Wise choice. Starting with small, steady trades helps Coin learn the ropes and protect his savings. Over time, consistent profits add up. Well done. Each wise choice lays a brick in your foundation. Now let's see what happens when Coin sticks to the plan. Time for a quick quiz. Coin now has $2,000 and earns about 5% per month by trading carefully. He reinvests his profits without adding new money. If Coin keeps going like this for 12 months, about how much money might he have by the end of the year? About $3,600? Still $2,000. About $1,600. Yes, you're right. Excellent thinking. 5% monthly growth compounded can turn $2,000 into about $3,600 in a year, even with no extra deposits. You're catching on. Let's raise the challenge a little. Coin's getting bolder. What happens next? Time for a quick quiz. Coin has been trading on a demo account for 3 months. He wins about 60% of his trades and follows solid risk management. He just switched to a $1,000 live account and wants to start growing his profits. What's a smart next step for Coin? Enter as many trades as possible each day. Start using high leverage to grow faster. Slowly increase position size while keeping his risk low.